Hello, beautiful people. Welcome to another brand new episode of the ITU Forex class. In this week's class, we're actually going to be talking about market structure. So, if you've been trading for any length of time, I'm pretty sure you must have come across price action or market structure. It's kind of interchangeable, but price action in and of itself embodies a lot more than market structure alone. So, price action pretty much refers to every kind of movement or physics of movement of price within the markets. Okay, so while market structure, when you isolate it in and of itself, it's usually referring to the kind of rhythm that price usually tends to exude when it's moving in the markets. Okay, so let's actually move on to the class proper. Okay, so what exactly is market structure? Okay, so let me give you an example. You see, for different species of animals that there are, usually what you tend to find is that there's kind of a peculiar way the animals tend to move or react. Okay, so let me give you an example using something like a snake, for example. Okay, unlike humans, which were created with legs, obviously, snakes usually move on their tummies, they kind of have this what do you call it, this wavering movements that they do on their tummy. That's kind of like the way they move. Okay, and humans move on their legs. Okay, when you're a child, obviously you're going to start from crawling, and then when you mature, you start moving on your two legs and all of that. Now, apart from humans and the example of an animal which I gave you in this example, which is a snake, there are also other animals that move on their tummies. Things like worms. Okay, for example, a tapeworm moves on its tummy. But then we have other animals which do not move on their legs and they don't move on their tummies, which actually fly in the sky. An example of that would be something like a bird. Okay, unlike humans, birds do have legs, but some birds in particular actually fly in the sky. They can actually do that. That's how they move. Now we could talk about all of the different ranges of motions that there are for animals throughout this class, but that's not the topic for today. The reason why I brought this analogy, this example, is to show you or to explain to you the fact that there are different type of movements for animals, and in the market is kind of not different. What I mean is, price has a peculiar way of movement that it exhibits in the market, and for countless years or hundreds of years that traders have been trading this market, technical analysts have actually studied this, and they've come to the conclusion that price has a particular structure that it moves within the financial markets. Okay, and that's what we're talking about today. So let me give you an example. You see, when price, for example, there was the time that Bitcoin, a couple of years ago, Bitcoin was on a bull run. It was crazy. Everybody was just like, everybody and their mom and everyone was just saying buy Bitcoin, buy Bitcoin, buy Bitcoin, because it was moving up very, very strongly at that particular moment in time. So it was a bull market, and it made sense to buy Bitcoin as at that point in time. Okay, but what I want you to do, this is actually an assignment, is to go and open the chart of Bitcoin, okay, and study it. Even though it was in a very, very strong bull market, it actually did not move up in a straight line when it was experiencing that bull market. And that's partly because the way that the price of an instrument move in the markets, in the financial markets, is actually governed by a kind of a rhythm that it moves with. The price of an instrument, no matter how strong it is trending, whether to the up or to the downside, is not going to move either up or down in a straight line. Usually what you're going to find is that the price of that instrument, depending on the direction of the trend that it's experiencing, is going to move up a bit if it's in an uptrend, and then it will pull back a little bit. Okay, but because it is in an uptrend, what you usually find out is that the pullback that it's going to do is not going to be so deep that it's going to take out the previous origin points where it started moving from. So what it's usually going to do is that it's going to move up strongly, and then it will pull back just a bit, and then it will move up higher, stronger than it did the previous time, breaking above the resistance where it couldn't break a couple of moments ago, and then it's going to make another pullback. But then this pullback, because the market, if the market is actually in a healthy uptrending market, then that pullback should have no reason whatsoever to come all the way down to this higher low. Okay, so it's usually going to be a pullback that is going to be somewhere within between these areas, but it should not come anywhere close to this, because if it does that, then this is a warning signal that the trend is actually not as strong as anticipated, or there is likely going to be a reversal just around along the corner. Okay, now when the market is in a healthy uptrend, this is the motion that is usually going to, the rhythm of the motion that is usually going to exhibit, okay, on the price chart. So it's usually going to be forming higher highs and higher lows. I say higher highs because this high compared to this high is actually higher, and this low, this pullback that is, compared to this previous pullback, it's actually higher. So this is a higher high because it's higher than the previous high, and this is a higher low because it's higher than the previous low. So in a healthy uptrending market, what we are expecting to see is for price to consistently keep forming, breaking above resistance, previous resistance level that it couldn't break above, and then consistently keep forming higher highs and higher lows, higher highs, higher lows, higher highs and higher lows. This is the typical movement of a uptrending market. But then price does not just move in an uptrend. Okay, there are instruments that also tend to exhibit downtrends. Okay, so what you're usually going to find in a downtrending market is the opposite of what the typical market structure of an uptrending market looks like. And that's going to be characterized by price forming lows and then lower highs. The reason I say a lower high is because this high is lower than this origin point high. And then this low, usually if this is a healthy downtrending market, then this low is going to be lower than this low. Okay, so it's going to be the formation of lower highs and lower lows, lower highs, lower lows, lower highs and lower lows. Now this is what is meant by market structure in a nutshell. Okay, and this is keeping things very, very simple. This is what is meant by market structure. When price is moving up in an uptrending market, it's not just going to move up, in a straight line. It's usually going to form an impulse wave. This highs that break above the resistance areas where price couldn't break above previously is also called an impulse wave. And then the retracement, where price just pulls back a little bit, is also called a correction. Okay, so you could either call it a pullback, a retracement, or a correction. Okay, and the impulse wave, you could either call it an impulse wave and extension, or an extension. Okay, so moving forward, this is just an illustration that I drew to show you or to explain to you what the market structure is. But now, to make things much more concrete and easy for you to understand and identify on charts that you're analyzing, let's take a close look at this particular price chart on the screen. Okay, so this is the chart of the US dollar against the Japanese yen. When you take a close look at it, when I zoom out, obviously as I'm doing right now, you'd notice one thing. The price of the USD JPY currency pair has actually been moving up over time. Okay, so you could see from all the way back here, which is, let's say, all the way back here to around Tuesday, the 7th of February, to now currently, which is the 26th of March, you'd notice that this particular instrument has been trending to the upside. It's been moving up because the price went from all the way down here, which is like at the 152.70 price level, to all the way up here to 157. About 90, or let's just say 158 price level. Okay, even though now we have a little bit of a pullback here. Okay, now what does this have to do with anything? Well, when you take a close look at the charts, you'd notice that even though the instrument, this particular instrument that we're analyzing now, has been moving to the upside, its price did not just go up in a straight line. And this is what I keep telling you guys about market structure. Okay? When the price of an instrument is strongly, whether it's strong or it's weak, the trend that it's exhibiting, it's actually not going to move up or down in a straight line. Okay? It's usually going to form extensions and retracements, impulse and corrections. Okay, this is all other the various ways that you could call this movements of price in the market. Okay, so as you can see on the screen, you'd notice that what we have here is price went up, okay, all the way up here, and it formed a pullback. Then it went all the way up here again, formed another pullback, went all the way up, formed this pullback, then went all the way up, and then again we have a pullback here. So this, when you take a close look at the charts, you would notice that this instrument has been forming what I told you earlier on, which is the formation of higher highs and higher lows. Okay, this is a higher high because this high is higher than this previous high, and this is a higher low because this low relative to this one is actually higher. And so in a healthy uptrending market, what we would expect to see is price forming higher highs and higher lows continually. But then everything that trends don't last forever, because usually what tends to happen is that the market is going to reach a point in price action where it's actually going to encounter a strong resistance or a weakness by the bulls who are pushing prices up, or bears who are pushing prices down in a downtrending market, and then that is going to cause the price of that particular instrument to either slightly retrace or correct or consolidate or even reverse altogether. Okay, and that's in a nutshell what market structure is. Okay, so you could see that price is forming higher highs and higher lows. This is a typical example of an uptrending market. And this is a typical example of the movement or the rhythm with which price moves in an uptrending market. This is the market structure of an uptrending market. The opposite is the case for a downtrending market. Okay? Now, here's an example of a downtrending market. Okay? And the market structure of a downtrending market. So this is the chart of the GBP USD currency pair. And if I zoom out a little bit, you'll notice that this pair has actually been going down for quite a bit of time now. So from all the way back here, which is around the 12th of February, you can see that this instrument went from forming the market structure of an uptrending market, which is characterized by the formation of higher highs and higher lows, higher highs and higher lows, to all of a sudden, it was then struggling to break above this resistance area. And then it went from forming the market structure of an uptrending market, which is characterized by the formation of higher highs and higher lows, higher highs and higher lows, to all of a sudden struggling to break above the previous resistance it had here, and now forming equal highs and not higher highs. Okay? And then it moved from forming higher highs to forming equal highs, then from forming higher lows to now breaking below its higher lows to now start forming lower lows. So it automatically went from forming the market structure of an uptrending market to forming the market structure of a downtrending market, which is characterized by the formation of lower lows and lower highs. Okay? Now, when you take a close look at this, you'll notice that even though this instrument over time, which is, I think, over the past couple of weeks now, has been going down, again, like I keep telling you guys, the price of an instrument, any financial instrument that is tradable or that you're trading in the market, whether it's a strong up or downtrending market, it is not going to move up or down in a straight line. It's going to follow the laws of market structure, the unspoken laws of market structure in the market, and then it's going to move the way instruments, the price of instruments move, which is, in this case, since it's a downtrending market, is going to be forming lower lows and lower highs. Lower lows, lower highs. Lower lows and lower highs. Now, why do I say this is a lower low and this is a lower high and all of this? It's simple, because when you look at this origin point, for example, where it started all the way up here, you'll notice that it formed this low. And then this high that it formed is actually in relative to this previous high, it's actually lower than this high. And that's why it's called a lower high. Now, what about this one? This is a low. And relative to this previous low, which got broken, this is a lower low. And so the structure of a downtrending market typically is going to be characterized by movements such as this, which is the formation of lower lows and lower highs, lower lows and lower highs, lower lows and lower highs. Now, if the downtrend is healthy, then it should continue forming this market structure continuously. But if for whatever reason it begins to lose steam, or the bears are beginning to lose the strength to keep pushing prices lower, and the bulls are now taking over the market, then this particular instrument is going to move from forming the market structure of a downtrending market, which is characterized by the formation of lower lows and lower highs, to now forming the market structure of an uptrending market or consolidating. Okay, which is, if it's the market structure of an uptrending market, then it will move from forming lower lows and lower highs to starting to form the market structure of an uptrending market, which is characterized by price forming higher highs and higher lows. Okay, now this is in theory how it is, you're usually going to see it on the charts. But if you've been doing anything in the trading niche for any period of time, you'd know that by now. You should know that it's not always this black and white. What I mean is, in theory, now that we explain it, it's easy to understand. And if you take a close look at a couple of charts, you'd notice that it's actually easy to identify this. But there are times when you're going to get complex reversals or movements and all of that in the market. This particular chart that we're analyzing now, it's a perfect example of this, because you could see that we were forming the market structure of a downtrending market, characterized by the formation of lower lows and lower highs. But then, all of a sudden, after price formed this low, it struggled to break below this low for some time. And then this was the lower high. But then, price just kept consolidating within this channel. Okay? You could see, this is a channel because you could see that when I pick this here and connect the tops of this particular highs, and then I pick this and connect the lows of these lows, you'd notice that we had a formation of a channel here. Temporarily, price went from forming the market structure of a downtrending market to forming the market structure of an uptrending market. But this is because price does not move in a straight line. In as much as it's going to move in the direction of one trend, there are times when it's going to consolidate and retrace. Okay, and you can see that even though it looked like we're forming the market structure of an uptrending market here, out of the blue, price struggled to continue doing that because the predominant trend, the direction of the predominant trend for this pair was bearish. And so it immediately stopped forming the market structure of an uptrending market, and then it broke below this higher low, and then it continued forming the market structure of a downtrending market, which is characterized by the formation of lower lows here, you can see, and lower highs. Lower lows, lower highs, lower lows, lower highs. And then again, we're struggling to break below this low here. And then price looks like it's kind of consolidating here. So we're waiting to see if it's going to continue moving in the direction of the trend or if it's going to reverse. If it's going to reverse, it's going to find it difficult to break below this low. And then all of a sudden, it's going to shift to forming the market structure of an uptrending market, which is characterized by the formations of higher highs and higher lows. But if it's going to continue moving in the direction of the trend, then it should be able to break below this low and continue forming the market structure of a downtrending market, which is characterized by the formation of lower lows and lower highs. So in a nutshell, this is what market structure is. Market structure is just kind of like a term that traders coined to refer to the rhythm or the nature with which price moves in the financial markets. No matter how strong a trend is of any tradable instrument, it is not going to move up or down in a straight line. It's usually going to move a little in one direction, and then it will retrace its steps a little to rest. And then it will move further, and then it will retrace its steps a little to rest. And then it will keep doing this as long as the trend is healthy. But then, trends do not last forever. So even though it's going to keep moving, advancing and retracing and advancing and retracing, there's going to come a point in time where it's going to find it difficult to keep advancing. And that's usually when reversals or consolidations or things like that are usually going to manifest. And then price is going to switch from forming the market structure of an uptrending market or a downtrending market to doing the opposite of that. Okay? So that's pretty much what we refer to as a market structure. Okay, now how do you trade this particular phenomenon? Okay, because it's one thing to understand market structure, and it's a entirely different thing to properly take advantage of this. Well, this is part of the things that we're going to be talking about in next week's class, but just to give you a sneak peek into what we're going to be talking about, there are actually two ways that traders use to take advantage of this type of phenomenon in the markets. Okay, the first one is to trade with breakout trading strategies, and the second is to trade with pullback trading strategies. So what do I mean by this breakout and pullback trading strategies? So here's the gist of it. Okay, let me quickly move the charts a little to make this illustration so that it's going to be easy for you to see. You see, in a typical uptrending market, like I just told you moments ago, price is going to be forming higher highs and higher lows, higher highs and higher lows, higher highs and higher lows. Now, if this is a healthy uptrending market, then price should continuously break above resistance areas to form brand new highs. And it should struggle to break below support areas to form lower lows, because by definition, if it's an uptrending market, then price should be forming higher highs and higher lows, not higher highs and lower lows. Okay, I hope you're with me. Okay, so in this case, the way some traders use to take advantage of this is they're usually going to take trades when price breaks above resistance areas. So let me show you an example using this particular illustration that I drew. Okay, using the breakout trading methodology, this particular resistance that price formed here before it pulled back, the idea would be that if the trend is really a strong uptrend, then at some point in time, price should be able to come to this resistance area and break above it and keep moving to form a brand new high. So what traders do, some traders in this situation, is they will wait for price to finish its pullback and its correction and whatever it's going to do here, and then they will place a buy stop pending order, for example, waiting for price to break above this resistance. And when it does this, eventually they're going to get into the market with a long trading position, and then risk management will do the rest. Now, this is for the breakout trading method. Okay, for the pullback trading method, instead of you waiting for price to break above this resistance and then taking a trade, what pullback traders usually tend to do is that they'll wait for price to hit a resistance area, and then when it's clear that it's finding it difficult to break above that resistance area and continue moving in the direction of the trend, then they'll wait for price to start forming the pullback. And then when they see spikes or rejection candlesticks or anything like that showing them that the pullback is likely ending, then they will take a trade in the direction of the trend, hoping that that's the end of the pullback. And then they'll be looking to catch that move, hold it up until price breaks above the previous resistance, and then keeps moving in their favor. So a pullback trading methodology would look something like this. And then, the exit might be your fixed risk to reward ratios and all of that. So this is the two methods that traders use to take advantage of trading using market structure. You could either be a breakout trader for waiting for price to show you clearly that it's going to break and continue moving in the direction of the trend, or you could wait for a pullback and then you take advantage of the trend using that pullback trading method. Okay, so this pretty much brings us to the end of this week's edition of the ITU Forex class, and I sincerely hope you've gotten a ton of value from it. But as I keep telling you guys, these are things that you don't just come to this class to learn, because if you just hear me tell you all about them and you don't practice them or try to implement them, it's just going to be a waste of your time and my time. And so please take time out of your schedule and all of that, dedicate some time and commit to this. so that you can implement what you've learned in this class. Back test it, forward test it, trade it live, and then, you know, after you've proven that it's profitable, you could trade it live, okay? And then put money behind it. But don't just rush to put money behind it without testing it and really proving to yourself that it actually works, okay? And so before we round